Alright guys, welcome back for another video. In today's video I want to cover the topic of how to perform equity fundamental analysis. And really one of the most important aspects of lending is analyzing a borrower's liabilities and net worth, for the most recent 3 years. And the main theme of this video is really that most financial crises and major institutional insolvencies generally occur when an organization skews towards borrowing too much short-term credit and locking up their assets in long-term lending structures. So basically, if I were going to get into the equity markets, you can use this tool or this alpha to identify, companies that have weak balance sheets with this skew towards short-term borrowing and long capital structures and long-term lending. And really that's the alpha here. In the rest of this video I'm going to just break down the different types of liabilities that you might see on a balance sheet. Not everybody will find this interesting, so if you're not an equity guy, you're not interested in equity fundamental analysis, I would skip this part of the video. But if you are interested, this is really for some people who are interested in doing a really deep dive. The type of guy who's interested in doing analysis and really digging deep into a company, and then the next step, putting on a trade. Shorting if the balance sheet doesn't look good, or longing if the balance sheet is extremely positive and you don't believe that's reflected in the price. So really liabilities are generally analyzed by their order of maturity date. So liabilities theoretically represent a company's obligation to creditors, while net worth represents the owner's investment in a company. In reality, both creditors and owners are investors in a company, and really the only difference between liabilities and net worth is the degree of nervousness and the date on which the obligation matures. Cash is supplied by company owners or by borrowing from a lender, suppliers, employees, or tax authorities. Because cash from suppliers and employees naturally arise out of buying and selling inventory at a profit, these sources are known as operating sources of cash. Since borrowing from lenders doesn't stem from the operating cycle, these sources are known as non-operating sources of cash. And really, current liabilities are liabilities that are due within 12 months and are considered the highest risk liabilities. Notes payable, accounts payable, accruals, taxes payable, and current portion of long-term debt. These are generally liabilities that can create insolvency if cash is inadequate within a company. The proper matching of sources and uses of funds requires that short-term liabilities must only be used to purchase short-term assets. Notes payable have a maturity date of less than 12 months and are often payable on demand, but other times have specific maturity dates. The notes payable section of a balance sheet pretty much always includes only the principal amount of debt. Any interest owed is listed as an accrual, and interest paid is reported on the P&L statement. Proceeds of notes payable should be used to purchase current assets that will mature into cash prior to the obligation's maturation. Proper matching would indicate borrowing for seasonal sales fluctuations that cause swings in inventory and receivables, or to prepay accounts payable when attractive discount terms are often offered for early prepayment. And using notes payable to take advantage of discounts is basically equivalent to using the proceeds to purchase inventory with cash. Notes payable to a bank are listed differently than notes payable on a balance sheet. Short-term notes payable to a bank include revolving lines of credit and credit cards from banks. This source of cash should only be used to purchase short-term assets. Notes payable to banks potentially are particularly troublesome because if delinquency occurs, the bank can just block or attach a company's cash accounts until the delinquency is cured. Because of a bank's strategic ability to stop the use of cash by a company, notes payable to banks are listed as the first and most nervous liability. Notes payable to suppliers and third parties are another red flag. Notes payable to suppliers on the liability side are really parallel to notes receivable on the asset side. A note payable to a third party indicates that the company could not secure money through traditional financing for whatever reason. Accounts payable are obligations due to suppliers who have provided inventory and services, and it's really the inverse of accounts receivable. So accounts payable and accounts receivable are inverses, depending on the relationship. Due to the competition, suppliers are generally forced to offer payment terms for their accounts receivable. Paying invoices in a timely fashion is the first source of credit for a starting company. Suppliers can refuse to ship additional supplies should any of the payments become delinquent. The supplier will generally ship inventory to a company roughly equivalent to the company's inventory cycle. A supplier is willing to finance a company's inventory, but because the supplier is not a bank, it has no interest in financing a company's accounts receivable. And as a result, typically a supplier wants to be paid prior to the company's conversion of the inventory supplied into a receivable, or in other words, prior to the conversion of those supplies into a finished product sale. And accruals listed on a balance sheet are expenses incurred but not yet paid. They're usually interest or wage related. Most accruals consist of wages, payroll taxes, interest payable, and employee benefits such as pension funds. The inclusion of interest accrued may make the category difficult to analyze, and accrued interest should be broken down into wage-related accruals and interest-related accruals. High accruals generally take the form of unpaid interest or unpaid taxes. And, generally other high accruals are major red flags. Current portion of long debt is the portion of long-term loans due within the next 12 months. This is generally divided into two segments. You have current long-term debt and long-term debt. The long-term debt with principal payments due within a year is listed as a current liability, and the non-current portion of long-term debt with principal payments beyond a year is listed as a long-term liability. It includes principal only. Any interest due is listed as an accrual. And long-term debt is generally used to acquire assets that mature into cash beyond 12 months. Again, matching the type of asset with the sources and uses of cash flow. This includes permanent working capital and fixed assets. Term debt can be troublesome because it usually has fixed assets as collateral that can be attached and removed if delinquency occurs. Just as a company can't operate without cash, neither can it operate without fixed assets. Long-term liabilities on a balance sheet are obligations that will not become due and payable in the coming year. There are two long-term liabilities listed on the balance sheet of a company: non-current portion of term debt and subordinated officer debt. Remember, if you're analyzing a balance sheet, you want to see a skew towards long-term debt rather than short-term debt. Remember, these companies get in trouble when they borrow too much in short-term liabilities and lend out locked capital and long-term lending structures. So actually seeing a skew towards that long-term debt is actually a good thing, considering the ratio and their loan-to-value ratio. But really long-term liabilities can be broken down into two different types, which is a non-current portion of term debt and also subordinated officer debt. And the non-current portion of term debt is the principal portion of a term loan that is not due within the next 12 months and, obviously will be repaid through future debt service. It provides cash to purchase long-term assets, either permanent working capital or fixed assets. Subordinated officer debt is actually generally a good sign. It represents cash that, officers have lent to the company, a true skin in the game indication that the executives in the company have faith in the future performance of the organization. For tax reasons, owners typically increase their equity investment beyond the initial company capitalization by making loans to the business rather than by purchasing additional stock. Any ROI or return on investment from this method can be paid as a tax-deductible interest expense rather than as non-tax deductible dividends. When a company borrows from a financial institution, officer loans are subordinated or put on standby. The subordination agreement prevents the officer from collecting their loan prior to the repayment of the institution's loan. Subordinated debt is generally considered equity by the senior lender. The net worth of a company, and it's the net worth as listed on the balance sheet, is the last to mature source of cash. It represents the owner's share in the financing of the assets. And common stock on a balance sheet represents the initial investment in a company. The capital surplus is the difference between the stock's sale price and the par value, which represents some arbitrary amount that is the lowest allowable by state law. The par value of a stock is credited to common stock, and excess is credited to the capital surplus. Paid-in capital is capital invested without the investor receiving stock in exchange. It's common for a capital surplus to get treated as paid-in capital. They are generally listed as on the same line in the balance sheet. Now, retained earnings are a balance sheet measure of the cumulative profitability reinvested in a company, representing profits earned and retained. They don't represent cash, but they do show earnings the owners could have withdrawn to use personally, but chose to reinvest in the business. This is generally a really good sign, right? It's showing executive faith in the company. Treasury stock occurs when a company purchases its own stock from a stockholder. Like a dividend or a withdrawal, cash from a company is given to the owner. The owner surrenders the stock certificates to the company, and then they are deposited in the treasury. When listed on a balance sheet, treasury stock should be subtracted from net worth because it's generally a red flag. It generally indicates that a company had to repurchase the stock to settle with one or more of the former owners who left the company. Again, a red flag. This generally points to disagreements between owners, retirement, or a death resulting in the company repurchasing the stock to settle with the estate of whoever passed. And finally, contingent liabilities are potential liabilities that may never come due and are relatively an insignificant part of the balance sheet. This actually applies to lawsuits against a company or the guarantee of a third-party loan. People may think of lawsuits and third-party loan guarantees as serious liabilities. They do have a negative connotation, but in reality, they don't represent actual liabilities, but only potential liabilities. So it's really at the point where a lawsuit becomes a real liability that it's something we need to be worried about. And also, if you're a guarantor for a third-party loan, that really only becomes a liability if that third-party loan becomes repaired and the guarantee agreement, begins to be enforced. And anyway, these are just, it's a broad overview of how to analyze the liabilities of a borrower, or, in the case of an equity investment of the company, in the process of analyzing the balance sheet. Again, when I look at a company's balance sheet, me personally, it's not financial advice, but I generally look to make sure that the company's capital structure is skewed towards not being heavily invested in or not heavily borrowing short-term capital, to be heavily invested or to have borrowed a lot of long-term capital that's not maturing within 12 months, and to have locked up its capital in lending structures that are more short-term. So you've got short-term lending capital structures and long-term borrowing structures. That's really what I want to see. If you see the inverse of that, that's generally going to be a red flag. It's going to be the type of company that you want to short or open a short position on, or at the very least sell. Again, this is not financial advice, just my opinion, the way I do fundamental analysis on equities. But I do hope you guys got some value out of this. If you did get some value, please just leave a like on the video, subscribe to the channel. I'll be uploading more similar equity-related videos in the future, so keep an eye out for those, and I'll catch you guys in the next video.